This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
The piece that needs to be added there is that you find a great deal, the money will come if you have the time, right? And most of the time, we don't have the time, right? Because now it's the clock starts ticking. Maybe you have 30-day duty, 30-day, of course, of getting to closing here. Maybe you have a 15 and 15. Maybe you have another 30 days. But at the same time, you have to get all your paperwork prepared, do your underwriting, do your due diligence, get your bank. Like, you're working on all these other things. You're trying to answer questions from the investors. You're now going to give them 150 pages that they've never seen before of just, of everything, of the investment summary, of the private placement memorandum, of the signing agreement, right? So as they look at all this paperwork, it's daunting, right? And they have their busy life, of which they are busy in their life doing stuff each and every day. And now you're asking a lot of the investor to understand the process, understand the project, understand if they haven't invested in real estate before, how it works, how it can benefit them.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Quick question. How'd you find this show? Maybe a tweet or an Instagram post? Well, no ads here. Just a small favor to ask. If someone introduced you to this podcast, pass it on. Share, review, tell a friend. It means the world to me. Thanks a ton. Hey everyone, it's Augustino. If you're looking to build your multifamily portfolio, it's important to have solid criteria, build your team, and take consistent action towards your goals. Now, opportunities exist in all markets when you have the right mindset and you have your eyes open for those deals. Now, our next guest knows all about this. He is the founder of Yarusi Holdings with his wife, Peely. They have acquired over $180 million of real estate across 1,500 units since 2017. Now, he's also an avid ultra runner and workout enthusiast. And he also hosts the Multifamily Alive podcast. So with all, I'd like to welcome my good friend, Jason Yarusi. So Jason, buddy, thanks for coming on, man.
Hey, it's great to be here. It's been a couple of years, which is crazy to say, man. And you were out at our event in New Jersey, and that might have been 2019, something to that fact. So yeah, it's been some time. So it's really good to talk again.
Yeah, good. It's good to catch up. Good to catch up. Yes. Now, guys, if you like what Jason has to say, and I'm sure you will, reach out to him via his contact page at yarusiholdings.com. Okay. So Jason, go ahead and tell the listeners what you've been up to since we last spoke.
Yeah, sure. So I probably have sent you a older bio in there. We're about 2,300 units, about 245 million in real estate. Portfolio is 90% multifamily, about 5% mix between storage, and then we have development and office for the other 5% right there. I'm down in Nashville. First we spoke, I was up in New Jersey, moved down here with my family to Murfreesboro, which is about 25, 30 minutes south of Nashville. Been here 3 years. And we're out there just doing our thing. We're a real estate investment firm, potentially always looking for opportunities on the multifamily side to find assets that we can reposition, just put our tried and true business plan into action. Of the 27-ish deals we've done now, we've had 13 full cycle deals, which has been nice for the investors as well. So excited to talk today, talk about where we stand in the market. It's been quickly changing and rapidly changing, and very interesting market where we stand today.
Interesting to say the least. But it's not the first time, right? You and I both know that. I mean, I know we're not exactly 80 years old, but we know a market cycle when we see it. That's for sure. But the one thing that I'm sure your mentors have told you, and what you've also read, is that this is a cycle, and people buy real estate no matter what happens, right?
When you think about cycles, you have to look too, and this is why it's really strong. Like, you're in Cleveland, I'm down here just south of Nashville, right? It's time to be really honed into your market, because not every single market reacts the same in every cycle. So we hear a lot about recession, right? We hear that in the news. We hear these talks about going into recession. However, if a recession happens in an area, it doesn't blanket the US all in one fell swoop, right? It's not like it hits every single spot exactly the same at exactly the same time. Some areas will get hard hit with recession. Others may just barely have a touch. Some may have it happen over the next 3, 6, 9 months. Others, they may not see something for the next 12 to 15 months if we get to that stage. So really being fully dialed into your market, fully understanding how your market's reacting, why people are moving there or still moving there or wanting to move there, the jobs that are available, the type of jobs, the diversity of jobs, right? The new construction, are we in an oversupply, right? There's so much housing on there. You're starting to see a lot more concessions coming out from apartment buildings or other communities right there. Are you seeing houses from the rental or from the sales side and the single family side? Are we seeing a part here where there's houses that are starting to sit on the market for longer in your market, right? That's why really being dialed in now and not having this shotgun approach where you're just trying to buy anywhere and everywhere and you say, this is my market, is really going to benefit you today because you're really going to capitalize on understanding how things are happening and what's going to potentially affect you down the pipe.
Yeah, no, I love that. There's something you said that's worth highlighting. What's the name of that one study? It looks like a cycle, right? And it talks about the 53 or 52 metros, as 52 MSAs, I think it is, or 53 MSAs. You know what I'm talking about?
I don't. If you get to it, I may actually have an idea, but I'm wondering if it just shows how they all reacted within it, because it's a winding metric of a line right there, showing where each of the markets is and potentially the time. Yes.
Yeah. I when you said that, that's what I thought you were referring to. I got to remember the name of that thing. But it's a report that these guys put out. I want to say Blackwater Group, I think it is, or something like that. But it's exactly what they talk about is at any given stage, every given quarter, different markets are in different stages of either hyperinflation or recession or whatever.
Yeah, correct.
So yes, there's a general recession across the board, absolutely, with the whole as a nation. But there's certain markets like here in Cleveland, it was never really that fast moving market. So it's like we see a slowdown, definitely, but it's not like it would be, say, in New York City or in San Diego or whatever, right?
It's not as pronounced, right? Because we don't have these upswings and these downswings in such a prolific manner here that the other side of it isn't so harsh. Either it's positive or negative fashion.
Exactly. But the one thing that you have to make sure of is finding the right team and putting the right deals together. So how are you guys looking at deals today? Are you guys still looking at the same sort of deals? Are you changing your parameters? What sort of methodologies are you applying when you're looking at deals these days?
So we're really staying in our backyard, right? And we're looking at opportunities to just find where the bid-ask spread is just making sense, right? Because for a lot of times, and even looking at ourselves, like if we're a seller today, we have to say, like, why should we take a discount? Like our properties are still performing well. We're still seeing, rent growth in our areas here. So it's hard for us to say, oh, we should just take a decline because the market's. But on the other side, and put my buyer hat on, I'm saying, man, you can't make these things pencil because the debt available today is nothing like we've seen before. So it's really hard to go out there when the offerings is, agencies, you're in the 6s, you get into, bank debt, you're in 7, 8s. It's hard to make anything make sense today when you have rates so high if the price stays high. So, we actually, where things can make sense is we brought a 32 unit right down the street from me the other day. We actually closed on Thursday. And the cool thing with that is that we were able to buy that with a loan assumption, right? So we were able to get into a Freddie Mac loan. The loan is 3.2%, still has 7 years left on it. So it gives us a good horizon to be able to make good decisions because it's 7 years. Some other avenues here is that we've been able to get into some projects where we're finding that we can get into attractive basis. However, the loan that we're getting is bank loans. We're getting a 5-year, 25-year AMOR or 5-year, 20-year AMOR with a fixed rate over 5 with maybe 1 year prepay. The cool thing here is that if rates keep going up, we're locked in for 5 years. Okay, so at least we know where our top is, right? But if rates transition into our favor, which most over here are going to say that we may not see some dramatic dip off, or we're going to see some leveling off over the next couple of years. To what extent, I don't know. However, having bank debt on there traditionally, even if it's a credit union, there's no prepayment penalty. With a bank, I might have a 3-2-1 or a 1-1-1, depending how it is. So my cost to be able to exit from this loan, if something down the pipe comes up that's better for me, is dramatically reduced compared to me locking into an agency loan where potentially I get a little bit better financing, but the penalty that I will pay if I want to exit this loan in years coming up will be dramatic if rates go the other way. And that's where, 24 months ago, you were seeing a huge run up in valuation, and you would see a lot of these sellers out there being like, hey, I want to sell my deal and, capitalize on this increased valuation I have that's just happened with the market here. But I locked myself into this 10-year agency loan, and so you have to assume it. But then at that time, rates were 5.5%, 6.5%, at some point 7%. Made zero sense, right? So today you look at some of those deals, maybe some of those deals will make more sense if you can find good debt, but also good debt at a reasonable leverage, right? At a reasonable leverage. Because sometimes you were seeing these things, you have to assume my horrible loan. And then if you look at the loan to value, it was like a 40% loan to value, right? Completely upside to where you want to be here with the capital stack.
Yeah. And loan assumption is a great way of getting into good, strong deals even today. And obviously you use that. Have you ever used like any other types of creative financing, like land contract or owner financing, or these other types of methodologies in some of these deals?
Yeah, absolutely. So I actually just brought a 44 unit in February, and we were able to get the seller to sell to us. He owned a free and clear, and he didn't want to take, of course, the huge tax hit. So he's actually seller financing it to us. It was 80% loan to value, and it's at a 6% rate. And the cool thing here is interest only, but it's a 15-year term. Right. He wanted to lock in for this point here for 15 years. And I was like, okay. But I got to the understanding of the back end is that it's him and his two daughters. He's 60. He said, okay, after 15 years, if you run this whole route with us, right, I'll be 75. My daughters can make a decision with you, what you want to do. Right. So his whole goal was to have some consistency in what's going to happen over this part as just a payment that he's going to get on repetition every month. And for us, it worked out great because if we were to go to the market at that time, it wouldn't have allowed this deal to work.
Yeah. Yeah. Well, and that's the thing. I mean, there's always a deal in every single market. And I think most people immediately they default to the local bank. There are creative ways of putting deals together. And we already talked about several here already. It's like, I think what it comes down to is just sharpening your pencil and being sure to underwrite the deals appropriately. Because I mean, I don't see expenses staying put. I think expenses are going to continue to go up. Taxes are certainly going to go up.
Correct.
So what matters now is your ability to underwrite the deal properly. Right?
Correct.
I mean, that's
and
what
if you look at that, there is opportunities to work on a lot of these parts here, but it also can make a lot of sense too, is that, you start seeing pressures on the sellers in other ways too. So you might have these parts where owner financing was off the table before, but now it might make that much more sense if they can guarantee their price, right? Because you're typically going to win on price or terms, right? You're not going to get both of them. And then so if you look at this part, you don't want to dramatically lose, but there has to be a give take, right? Because on the other side of it is the other partner, right? It is your partner in this dance until you get to the finish line of a seller and a buyer. And neither wants to give it all away, but each one has to feel like they've been able to accomplish something and feel good about the transaction for you to have a successful transaction.
Yeah. Yeah. But that's a really good way to look at it too, is that it's that whole give and take thing, because really, if the bank's going to be making a couple points on that deal, why not just take a discount, have the seller carry some of that paper back and get into a deal? That's it. Yeah, it works out great. It works out great that way. So are you still syndicating the deals then? Or like how's that process look like as far as getting your hands on the equity for the deals?
So about 75% of them we syndicate. The other 25% are a mix between ours and a partner, right? Of the 75%, like the one last week, 32 unit, smaller raise, and we filled it up really quickly, right? And so the goal is we've been able to capitalize to just do this business plan and repetition. So the market, there is fear in the market. So I'm not going to say everybody's still on board to go out there and invest. People are worried about their funds for good reason, right? Everything you look around us, we have uncertainty within the news, war, the election cycle coming up, right? But that said, if you look at multifamily real estate over the course of a rolling 10-year average, right, and you go back and just look at the rolling 10-year average here, it's outperformed stocks and bonds. Why? Because it provides consistency. Someone needs a place to live. Each month, they're going to pay a rent payment, right? It's going to have this consistency of cash flow. You have short-term leases. So these short-term leases allow you to react to the market, right? Because you're not locked in for 3 or 5 years. You're not going to get into some office cycle or retail cycle where you're locked into something and the market goes up and you can't push your rents up, right? You have this ability to be in good markets where people have job drivers and other things keeping them in the market. And you have the ability to force improve the property too, to increase the revenue streams in many other ways, or even maximize on reducing expenses or doing other energy savers to capitalize on lowering your expenses as well. So it's one of the few asset classes where you can win in just a dramatically fashion in many different ways on the property level. And then from the investor level, not only can you leverage, right, get some leverage so you can maximize your returns, but you can also get appreciation that we built in through forced appreciation. The market can help if you're in the right market in the right time, and then you can get depreciation or tax savings, right? So it's one of the few, we'll say, investment vehicles that just gives you so many different ways to win compared to just a stock where, hey, you put this dollar in, you get $1 back of stock, and within a year it either goes up or goes down or does something else in the middle, and you either have less or more, and that's the options.
Right. Well, we unlike multifamily, where there's actual contracts called a lease agreement with individuals that they're subjected to that lease agreement and they have to pay, right? And if they don't,
Correct.
there's a legal remedy.
Yep.
So yeah, it's very hard for people to get a hold of that, to understand that part, right? It's that's a beautiful thing about real estate. It really is. It really is. So I know you've been at this for quite a while here, trying to get your hands on the equity then, as far as like helping some people overcome fear. Because I mean, we've interviewed a lot of folks here on the show, and I mean, certainly everyone's, they say that it's a little tougher these days. I mean, it's
Absolutely.
tougher to raise equity. So how do you, aside from all the things you just mentioned here, it sounds like you mentioned, I picked up a few key things. Operations is a real big part of it too, right? And your track record. What other methodologies or what other things do you point out to these investors to give them comfort in knowing that this is the place for them to be? Hey folks, if you're having a blast, let's take it a notch up. Connect with me on Facebook, Instagram, and YouTube, and all the social media platforms where all the fun is happening. Your feedback is like fuel to us, propelling us to even greater and better content and reach to incredible investors just like you.
Yeah, ideally, you're never going to force anyone to invest. And so your goal here is that you want to educate your investors. And the goal is that you can do this before you have a project on hand, because if you have a project and you're trying to raise funds, well, now there's a time and there's a need, right? So you no longer come from a position of giving, you need to give and get something back, right? So I've come out there, and is my investments, are investments going to be right for everyone? Absolutely not. But however, if we can give them the good guidance to be able to make a good decision for themselves, then they can make a great decision to understand why this can be a very good position for them to invest in. And if it's not the right time, well, no problem. Here's everything you need to know. So when it is the right time, you are in the position to make a great decision to invest with us. So ideally, the biggest piece that you want to do is go out there and educate those around you. So when the time comes, when you have the project, they've already gotten through all of the nuts and bolts questions, and they can truly understand this is a good investment for me, or something that can benefit me and my investment goals, and I should invest in multifamily real estate. When you do that, you'll find a lot of people are in the best position to timely invest with you, because now you've taken the time to, you'll say, curate their needs without the point of just saying, hey, I got this project, I need to know by Friday, right? No one wants to be in that position. No one has that time. It's not a comfortable feeling, and you're being sold, right? So if you do that, by the time you have a project in front of you, well, is it going to be right for everybody? No, but you already have a good indication based on the feedback of who is ready to invest. And it will also make you more confident when you are raising for your projects, because you've already done the legwork, right? You're not having to go out there to so many people that you just don't even know what side of the fence you're going to be on.
I think that's important to reiterate, because many people, the capital raise starts as soon as they find the deal. And it's like literally they'll find a deal on Monday and do exactly what you said. By Friday, they're already in front of them saying, invest $100,000 with me. It's just doesn't work that way. There's this myth. I call it a myth. If you find the deal, the money will come. Yeah, but you have to start raising capital way before that. And exactly how you said it, educating people, building up the top of the funnel, because not all these people are actually going to invest with you. They will nod their head. They'll say that they will, but
well, the piece that needs to be added there is that you find a great deal, the money will come if you have the time, right? And most of the time, we don't have the time, right? Because now it's the clock starts ticking. Maybe you have 30-day duty, 30-day, of course, of getting to closing here. Maybe you have a 15 and 15. Maybe you have another 30 days. But at the same time, you have to get all your paperwork prepared, do your underwriting, do your due diligence, get your bank. Like, you're working on all these other things. You're trying to answer questions from the investors. You're now going to give them 150 pages that they've never seen before of just, of everything, of the investment summary, of the private placement memorandum, of the signing agreement, right? So as they look at all this paperwork, it's daunting, right? And they have their busy life, of which they are busy in their life doing stuff. each and every day. And now you're asking a lot of the investor to understand the process, understand the project, understand if they haven't invested in real estate before, how it works, how it can benefit them. Now, here's all these paperwork I have to understand too, and get it signed. And then I have to wire you money, right? That's a tall ask for someone in a timely manner. It's just a lot. So the more you can take off all of the a lot off someone's plate and just make it that you can just hit the easy button for them because you've already done the hard work, right? That's when you can see a lot of success in your capital raising.
Yep. That's important to mention too, is that, or reiterate, is that your job as a syndicator, for people listening, of course, is to make their life a whole lot easier. And if you make it difficult for them, they're not going to lose interest, of course, but your job is to make it easy for them. Get a yes out of them, right? And
correct.
You do that by limiting barriers. That's how you do it. That's how it's
correct.
Yeah, absolutely. So when you're saying earlier that the bulk of your portfolio is multifamily, I know you've been in multifamily for a very, very, very long time. But you did also mention self-storage. Was it just self-storage, and there's another asset in there, right?
So we have self-storage here in Nashville. We actually just sold off 2 smaller complexes, but we just purchased a complex about 5 months ago now. It was built a year ago. Right. So the seller had some pressure. So it offered us that we're outside of the need to sell this property. So we were able to get into it at a considerably discount from our opinion of where the value stood with this property. So great property right here in our backyard. Also have development also here in our backyard. So we actually just sold a 72 unit land site that we got basically ready to go. Right. And we sold it off last week. And then we have 2 other projects, an 11 unit and a 236 unit here also. Right. So those are ones that we know can fit the market, fit the need, and fit the energy of what we want to provide here. And then we have an office community that's over in South Carolina, very simple 7-tenant, 5-unit or 5-building office building over in South Carolina. Great tenant base, really desirable tenants there. And that one just hums along.
Now with those ones, did you get into those other alternate asset classes because you saw the stickiness in multifamily, or you just saw those as opportunities?
Opportunities. So the ones here with development, we come from construction background up in New Jersey, and I knew in New Jersey it wasn't going to make sense for us to develop. However, when we got here, things make a lot more sense. But I didn't want to be in New Jersey developing in 1,000 miles away. I just didn't want to be doing that with just the complexity of the project, having all the inner knowledge of these markets right now. I didn't feel that it would be the most advantageous move or the best case for investors to be doing this 1,000 miles away. So when we got to the market here, we started looking for opportunities where we could use our inherent knowledge that we've built in the construction industry along with finding development opportunities.
Yeah, good. Yeah, I mean, I like the self-storage business. Yeah. I think that it could be, especially if you do a lot of automation and a lot of a lot of technical upgrades. You can make it. It could be a great way for someone to for the actual user to get in there, get the lock, sign up for their own box. It's tremendous. It's beautiful.
Yeah, we have it. And I built a year ago, so it's got a kiosk, right? To go in there, they can sign up in the kiosk and pay at the kiosk and set up an automated payment. They get their gate code right there. The gate opens up. They go in there to their unit. They're ready to go, right? So you make it very easy. It also has a RV, boat, and car parking, right? Some covered, some not. So has a lot of other advantages to it. Has a climate controlled for about 65% of them, 35% non-climate controlled units. So very good mix. And the area is right next to a brand new development coming on in a really desirable town called Mount Juliet. Also has the Amazon facility is maybe a quarter mile away. Has a couple other developments right down the road. So it has so much path of progress around us. So we walked into a really nice opportunity.
Now, just syndicate that one as well?
We did. Yeah, we syndicated that one as well there.
So when you syndicate these types of deals, maybe there's someone listening that's like, I've done a lot of multifamily. Maybe they want to pivot to an alternate asset class. They don't want to get away. Like we do 3 different asset classes plus our training and education. We do a variety of different things too. But self-storage is one of those things I truly love. So how did you overcome? I would imagine you had some static maybe from your investors. Like, what do you mean? What do you mean, Jason? You're a multifamily guy. You don't do self-storage. What are you talking about? Did you have to deal with some of that?
It's education again, right? Because the same thing is a confused mind says no. So you don't want to be, we have been 90% multifamily, but these other 10% is opportunity, right? So if every week I'm, 1 week I'm into motels, and the next week I'm into, anything Forex, and the next week I'm into self-storage, and the next week I'm into flipping, right? The investors are all over the place. They don't know which way I'm coming. They're just like, I don't know what's happening here. So I'm going to stay in the sideline, right? But when we have the part where it's just nothing to see here, multifamily, and then all of a sudden we come up with something that's treated the same way, right? So it's going to be the same kind of investment profile in terms of just the offering, right? So there can be preferred return, a split of equity. So it's not changing the investment structure. It's just using a different investment type. But the reason we're using this investment type is because it offers a lot of the advantages that we also find in the multifamily side, right? And so we are able to translate the same business plan over to self-storage, and we'll have, operational costs are less, of course. The rents are not as high, but then you have short-term, 30-month rolling cycle and rents. You have the opportunity to capitalize with the same marketing strategies and the same operational strategies that we use in multifamily. So we're able to transition the business plan in a lot of ways, one-to-one to the same process, give them like kind of returns, and still in the same time be able to do the same kind of investment profile that they're used to. So it's not changing the narrative here that they're coming in to invest in this thing, and now it's going to be completely different than how they would invest in the other ones.
Yeah. I mean, so same formula then, right?
Correct.
Regardless, you still have a great team that's able to handle it and run the asset. That's consistent across the board for any type of thing you're doing. The right underwriting, so you understand how that's put together. Even the deal itself, the structure of the deal, the PPM, I imagine, is somewhat similar, if not even close to identical, I would even dare say,
Correct.
right?
Yep.
So the education component is, as long as you're staying consistent with your brand, consistent with the messaging, it makes it way easier. So essentially then, like we said at the very beginning, how we opened up the show, it doesn't matter what's going on in the market. The underwriting will still tell you if the deal makes sense or not. Correct. Because the cost of the money has gone up, that we know. That makes a lot of deals out of reach. That's okay. There are other deals out there that maybe it's owned by someone that really wants to unload the deal. They're done with real estate. Maybe they have there's something happening in their family. They want to get out of they need a liquidation event to take care of whatever family issues there are. Could be a bunch of things, but there's always opportunities, and you have to keep your eyes open for those opportunities. And that's how it's done in this business. So for people to get scared, it probably doesn't make a whole lot of sense. It just means you just have to get out there and look at a lot more deals. That's what
you overcome fear by getting specific and really learning, right? And so you get specific, and that's the hardest thing to do is get specific. And that's why I really harp on getting to having your core market, because you're going to get to specific, and now you're going to be able to underwrite. Many times people will be like, hey, I got this deal in Houston. I was like, I thought you're in South Carolina. They're like, yeah, but someone sent me this deal in Houston. I'm like, okay, what are you doing in Houston? They're like, well, it looks good. Based on what? Well, the numbers look good. Well, based on what, right? They don't know anybody in the market. They have no team in the market. They don't know the type, the insurances, or what kind of debt would be available, or how the operational expenses are, or, what the taxes are, what kind of assessment it is. So it looks good just based on wild guesses, right? And so anything looks good when you're just wildly guessing. But the more that you harp on being very specific and really honing into your numbers, the more true and the more confident you'll become, because you'll truly understand how things are going to react. But where we create fear is that it looks good, but I don't know. Well, yeah, but you don't know because you're not being specific to learn your actual field, right? It would be like if I'm going to be, a doctor, but doctors have specialties, like someone going to like specialty surgeon, right? But if I'm like a foot surgeon and like the next day I'm doing like facial plastic surgery, right? And like, well, yeah, I'd have fear doing it because I've never trained in this. Yeah, just not my core competency. I don't know, but I'm just, going out there doing something. That's like what we're doing when we're underwriting projects that are just so foreign to us, because we're not making true assumptions, right? We're just making guesses.
That's right. Yes. And that's why I'm a real big believer in just picking a handful of markets and honing in on those markets and know all you can about it, become 100%. A leader in that market. Yep. 100%. Yes. Well, good. Well, listen, we covered a lot of stuff here today. What sort of bulletproof advice would you have for someone that's kind of, I would say, a little bit fearful about what they're seeing in the market today about investing in real estate? Like, what sort of bulletproof advice would you have for them? Having a blast so far? You're ready to jump into real estate? Visit bulletproofcashflow.com for free resources, and as well as some masterminds there for you to take a look at. Unleash your potential. Go ahead and check it out now.
If you look at the long-term horizon, you have a built-in business plan that has cash flow, long-term debt, and reserves. You have a hard time losing if you have a solid business plan that's not short-term affected, right? And so if you don't need to make some short-term reaction, you have a lifeline, be able to do many different things over the course, right? So having a true business plan that gives you multiple options down the pike puts you in the best position, right? And if you want to talk to us too, we're happy to talk. Come over to Yarusi Holdings here. We'd be happy to have a conversation, talk more about what we see in the market and how we're reacting, what our business plan looks like.
Nice. Excellent. All right, guys. Well, you want to reach out to Jason, you can hit him up at yarusiholdings.com. We've covered a lot of stuff here today, but ultimately you got to surround yourself with positive, driven people. Okay. These people are the ones that are going to help you get that deal over the line. They're going to help you underwrite the deal. They're going to help you put the deal together and then hopefully, conceivably, get into a deal of your own, right? Which is ultimately what we're looking to do. Okay. So thanks for tuning in, guys. I'll see you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.